Major Social Security changes coming in 2026. Why seniors must pay attention. If you're currently receiving Social Security SSDI or SSI benefits, or if you plan to claim them soon, the year 2026 is shaping up to be a critical turning point. According to official updates, there are multiple rule changes and financial adjustments that will directly impact monthly benefit checks for millions of Americans. Some of these changes are positive and may slightly increase income, but others could reduce benefits or trigger penalties if beneficiaries are not prepared. What makes this especially important is that many of these changes happen automatically, without warning letters or reminders from the Social Security Administration. That means if you don't understand the new rules ahead of time, you could find yourself facing reduced payments, overpayment notices, or unexpected deductions. This update affects four major groups: retirees collecting Social Security before full retirement age, seniors who continue working, people receiving SSDI disability benefits, and low-income Americans relying on SSI. In addition, Medicare premiums and cost of living adjustments are also changing, which could impact how much money actually lands in your bank account each month. In this series, we are breaking down 14 key sections so everything is explained clearly, step by step, in plain English. You don't need to be a policy expert or financial professional to understand what's coming. You just need the right information at the right time. By the end of this video series, you will know which rules apply to you, what income limits you must watch, and what actions you may need to take to protect your benefits in 2026 and beyond. Staying informed is no longer optional. It's essential. The 2026 earnings limit. What happens if you claim early and keep working? Let's start with a rule that hits millions of retirees every single year, and in 2026, the numbers are changing again. If you're collecting Social Security retirement benefits before your full retirement age and you will not reach full retirement age at any point in 2026, you fall into the first earnings limit category. In plain terms, this usually means people who claimed benefits early, often between ages 62 and 66, and are still working at least part-time. For this group, the 2026 annual earnings limit is $24,280. That works out to a little over $2,000 per month. What does this number actually mean for your check? It means you can earn up to that amount from work without a penalty. But if your wages go over $24,280, Social Security applies a reduction. And the reduction rule is simple but painful. For every $2 you earn over the limit, Social Security withholds $1 in benefits. So let's put that into a real-life example. If you go $1,000 over the limit for the year, Social Security can reduce your benefits by $500. For many seniors, that's not just a small adjustment. That's groceries, utilities, or a car payment. Now, here's the part that confuses people. That money is not always gone forever. Once you reach full retirement age, Social Security will recalculate your benefit and essentially pay back what was withheld, but it comes back gradually over time, not in one big refund check. Who is most at risk here? Retirees doing side gigs, part-time workers, seasonal employees, and anyone who underestimates their yearly income. The biggest danger is not the rule itself, it's the surprise. People go over the limit without realizing it, and then they get hit with reduced checks or an overpayment issue later. The takeaway for 2026 is clear. If you claimed early and you're still working, you must treat $24,280 like a guardrail. Track your income carefully because once you cross it, the reduction formula starts immediately. Reaching full retirement age in 2026, a much higher earnings limit. Now let's move to the second group of retirees. And this is where many seniors get confused because the rules change dramatically depending on when you reach full retirement age. If you are currently receiving Social Security retirement benefits before full retirement age, but you will reach full retirement age at some point during 2026, you fall into a special transition category. This group gets a much higher earnings limit, but only for part of the year. For these beneficiaries, the earnings limit for 2026 jumps to $65,160 and nearly 3 times higher than the limit we discussed in Part 2. However, this higher limit only applies from January through the month before you reach full retirement age. Let's break that down clearly. If your full retirement age month is October 2026, Then from January through September, you can earn up to $65,160 without triggering a full penalty. Once you reach your full retirement age month, the earnings limit disappears entirely, which we'll cover in the next section. If you do earn more than $65,160 before reaching full retirement age, the reduction formula is different and less severe. Social Security withholds $1 in benefits for every $3 you earn over the limit. So instead of losing $500 for every $1,000 over the limit, you would lose about $333. That's still painful, but it's far less harsh than the early retirement rule. Just like with the lower earnings limit, this withheld money is not permanently lost. Once you officially reach full retirement age, Social Security recalculates your benefit and slowly credits that money back into your future monthly checks. Who benefits the most from this rule? Seniors who are easing into retirement, people finishing out a final working year, or retirees who want to maximize income before fully stepping away from work. The biggest mistake people make here is assuming the higher limit applies to the entire year, including after full retirement age. It does not. Timing matters. Your birth month matters. And misunderstanding this rule can still result in withheld benefits if income spikes earlier in the year. The key lesson for 2026 is this. If you are reaching full retirement age during the year, you have more flexibility, but you still need to plan carefully and track income month by month. Full retirement age reached. Why the earnings limit disappears completely. This next rule is one of the most important milestones in the entire Social Security system. And for many seniors, it's also the most liberating. If you are already at your full retirement age when 2026 begins, or you reach full retirement age during the year and move past that month, one major restriction completely disappears: the earnings limit. That's right. Once you hit full retirement age, there is no earnings cap at all. You can earn $30,000, $75,000, $150,000, or even more, and your Social Security retirement check will not be reduced by a single dollar. There are no penalties, no withholding rules, and no income tracking requirements tied to your benefit amount. This is a major shift from the rules we discussed in parts 2 and 3. Before full retirement age, every dollar earned must be watched carefully. After full retirement age, that stress is gone. For many seniors, this opens the door to new opportunities. Some choose to work full-time again. Others take consulting roles, seasonal work, or start small businesses. Veterans, skilled professionals, and experienced workers often find that employers value their expertise, and now they can earn freely without risking their monthly benefit. It's important to understand one thing clearly. Earning unlimited income does not increase your Social Security benefit automatically once you're already receiving payments. However, if your new earnings replace lower earning years in your record, Social Security may recalculate your benefit and raise it slightly over time. The bottom line for 2026 is simple. If you have reached full retirement age, work decisions are now yours alone. Your Social Security check is protected, stable, and no longer tied to how much you earn. 2026, the strict income limit that can put benefits at risk. Now we shift away from retirement benefits and move into one of the most sensitive areas of the Social Security system, SSDI, or Social Security Disability Insurance. If you are receiving SSDI, the rules around working and earning income in 2026 are far stricter than they are for retirees. This is where many people get into trouble, not because they're doing something wrong, but because they don't realize how low the income threshold actually is. For non-blind SSDI beneficiaries, the key number you must know for 2026 is $1,690 per month in earned income. This is the limit Social Security uses to determine whether you are engaging in what they call substantial gainful activity, often shortened to SGA. If your monthly earnings stay at or below $1,690, your SSDI benefits are generally safe. But once you earn even $1 over that amount, Social Security may decide that you are capable of working at a level that disqualifies you from disability benefits. And this is not just a small adjustment. Going over the SGA limit can trigger a review of your disability status, reduction or suspension of benefits, an overpayment notice demanding repayment of money you already received. Many SSDI recipients believe that working a little extra is harmless. Unfortunately, Social Security does not see it that way. The system is very rigid and it does not forgive small mistakes easily. Another major issue is timing. SSDI income limits are measured monthly, not annually like retirement benefits. That means one busy month, overtime pay, or a temporary contract can put your benefits at risk, even if your yearly income seems modest. This is why SSDI beneficiaries must be extremely cautious. Track income carefully, report changes promptly, and never assume that part-time work is automatically safe. In 2026, $1,690 per month is a hard line. Cross it, and you could face serious consequences that take months or even years to fix. SSDI for the blind, a much higher earnings limit in 2026. In Part 5, we talked about how strict the income limits are for most SSDI recipients. Now, let's focus on a special SSDI category that follows a very different rule. SSDI beneficiaries who are legally blind. If you are classified as blind under Social Security's definition, your earnings limit in 2026 is significantly higher than it is for non-blind beneficiaries. This difference is not minor. It can be the difference between keeping your benefits and losing them. For blind SSDI beneficiaries, the substantial gainful activity limit in 2026 is $2,300 per month in gross earned income. That's more than $600 higher per month than the non-blind limit. What does this mean in practical terms? It means that blind SSDI recipients have more flexibility to work, earn income, and still maintain their disability benefits. Many blind individuals are able to work in adaptive roles, use assistive technology, or take on specialized jobs, and Social Security recognizes this by allowing a higher earnings threshold. However, the risk does not disappear. If your monthly income goes over $2,300, Social Security can still determine that you are engaging in substantial gainful activity. And just like with non-blind SSDI recipients, that can lead to a review of your disability status, suspension or termination of benefits, overpayment letters demanding repayment. Another critical issue is classification. Many people assume they are considered blind for SSDI purposes, but Social Security uses a very specific medical definition. If your records do not clearly show that you meet that definition, Social Security may apply the lower $1,690 limit instead. That's why it is essential to confirm your status directly with the Social Security Administration. Do not rely on assumptions. One wrong classification can cost you thousands of dollars over the course of a year. The takeaway for 2026 is simple but powerful. If you are a blind SSDI beneficiary, your higher income limit gives you more room to breathe, but only if your status is correctly documented and your earnings are tracked carefully. SSI in 2026. Higher monthly payments, but the same old asset limits. Now we turn to SSI, Supplemental Security Income, a program that supports some of the most financially vulnerable Americans, including seniors with very low income and people with disabilities who have limited resources. For 2026, there is some good news for SSI recipients, but also a familiar frustration that has not gone away. Let's start with the increase. If you are an individual receiving SSI, the maximum federal benefit in 2026 rises to $994 per month. That's an increase of $27 per month compared to the previous year. While this may not sound like much, for many SSI recipients, even a small increase can help cover essentials like groceries, transportation, or prescription copays. However, it's important to understand what this number really means. $994 is the maximum federal amount, not what everyone receives. Many SSI beneficiaries receive less due to other income, in-kind support, or state-level adjustments. Now let's talk about the part that continues to cause frustration across the country, the asset limit. In 2026, the SSI asset limit for individuals remains stuck at $2,000 in countable resources. That includes cash, money in checking and savings accounts, and certain other assets. This limit has not changed despite rising costs of living and inflation. For many seniors, this creates a painful situation. Saving even a small emergency fund can push someone over the limit, risking their SSI eligibility. It forces people to remain in a constant state of financial insecurity, spending down resources instead of building stability. Social Security does not currently adjust this asset limit with inflation, and while lawmakers have discussed reforms for years, no changes are scheduled for 2026. The takeaway for individual SSI recipients is clear. Yes, the monthly payment is slightly higher, but the system still strictly limits how much you can save. Careful planning and monitoring of your account balances remain essential. SSI for couples in 2026. higher payments, but the marriage penalty remains. In Part 7, we looked at SSI benefits for individuals. Now let's focus on married couples receiving SSI because the rules and the financial impact are very different when two people are involved. For 2026, SSI couples will see a modest increase in their maximum federal benefit. The maximum monthly payment for an eligible couple rises to $1,491 per month, an increase of $41 compared to the prior year. On paper, that may look like progress, but when you break it down, the increase still does not reflect the true cost of living for two people sharing housing, food, medical expenses, and utilities. Just like with individual SSI recipients, the asset limit remains unchanged. For couples, the limit stays at $3,000 in countable resources. That means two people together are only allowed to have $1,000 more in assets than a single person, a rule that many advocates consider deeply unfair. This brings us to one of the most controversial aspects of SSI, the marriage penalty. Despite years of discussion and proposed reforms, the marriage penalty is still fully in place for 2026. When two SSI recipients marry, their combined benefit is less than what they would receive if they remained single. In other words, the system financially penalizes marriage. For many seniors and disabled individuals, this creates an impossible choice: maintain financial support or formalize a personal relationship. The rules push people to remain unmarried or live separately on paper, not because they want to, but because they cannot afford to lose benefits. There are no automatic exceptions for long-term relationships, shared medical needs, or caregiving responsibilities. Social Security applies the couple rules strictly, and mistakes can result in overpayments or benefit reductions. The reality for SSI couples in 2026 is this: while the monthly benefit is slightly higher, the structure of the program still limits financial independence and discourages marriage. Planning ahead, understanding reporting rules, and monitoring assets closely remain essential. Work credits. In 2026, how much you must earn to qualify for Social Security. Now let's talk about something that often gets overlooked until it's almost too late: Social Security work credits. To qualify for Social Security retirement benefits, a worker must earn 40 work credits over their lifetime. These credits are the foundation of the entire system. Without them, you simply do not qualify for retirement benefits no matter your age. Here's how it works. You can earn up to 4 credits per year, and those credits are based on how much you earn from work that is subject to Social Security taxes. In 2026, the amount required to earn 1 credit increases again. For 2026, you must earn $1,290 in covered wages to earn 1 credit. That's up from the previous year. To earn all 4 credits in 2026, you must earn at least $7,560 total for the year. Once you reach 40 credits and you are at least 62 years old, you become eligible to claim Social Security retirement benefits. This rule is especially important for people who have had gaps in their work history. Stay-at-home parents returning to work, caregivers, people who experienced long periods of unemployment, or workers who spent years in part-time roles often underestimate how close they are, or are not, to reaching 40 credits. The good news is that credits are permanent. Once earned, they never expire. Every dollar you earn in covered employment builds toward eligibility, even if it takes many years. The risk comes when people assume they already qualify, only to discover late in life that they are short a few credits. That can delay benefits or force someone to keep working longer than expected. The takeaway for 2026 is simple. If you are still working and not yet retired, make sure you understand how many credits you already have. A few months of additional work could make the difference between qualifying for Social Security or not. Maximum taxable earnings. In 2026, who pays more into Social Security? In this part, we turn to a change that does not affect everyone directly, but still plays an important role in the overall health of the Social Security system. This is the change to the maximum taxable earnings cap, sometimes called the wage cap. Here's what that means in plain English. Social Security taxes are only applied to income up to a certain limit each year. Any earnings above that limit are not taxed for Social Security purposes. In 2026, that limit is going up again. For 2026, the maximum taxable earnings amount increases to $185,500. In the previous year, the cap was lower, so this change means Higher earners will pay Social Security taxes on more of their income. How much tax are we talking about? For employees, 6.2% of wages up to the cap is withheld for Social Security. Employers pay another 6.2% for a total of 12.4%. If you are self-employed, you effectively pay the full 12.4% yourself. This change primarily affects the top 5 to 10% of earners in the country. For most seniors, retirees, and SSI or SSDI recipients, this change does not directly impact your paycheck. However, it does matter for two reasons. First, for people who are still working and earning higher wages, this change slightly increases their tax burden in 2026. That can affect tax planning, especially for self-employed individuals and small business owners. Second, the additional tax revenue goes into the Social Security Trust funds. While this increase alone does not solve the long-term funding challenges facing Social Security, it does provide a small boost to system revenues. The key point to understand is this: raising the taxable earnings cap brings more money into Social Security without cutting benefits for current recipients. That's why policymakers often adjust this number year after year. The 2026 COLA increase. When your Social Security check actually goes up every year, one of the most anticipated updates for seniors is the cost of living adjustment, commonly known as COLA. For 2026, that adjustment has been officially set at 2.8%, and it applies to all Social Security beneficiaries, including retirees, SSDI recipients, and SSI recipients. At first glance, a 2.8% increase sounds like good news, and in many ways it is. But it's important to understand when the increase actually starts and how it affects your real take-home amount. Here's the key point that causes confusion every single year. The COLA increase begins in January 2026, not December. Many seniors expect to see the increase reflected in their December payment, especially around the holidays. That does not happen. December payments are still calculated using the previous year's benefit amount. The higher COLA adjusted payment shows up with your January 2026 benefit, which is usually paid in late December or early January, depending on your payment schedule. Another detail many people don't realize is this: even if you are not yet collecting Social Security, as long as you are eligible and at least 62 years old, the COLA is still being applied to your benefit behind the scenes. That means when you eventually claim benefits in the future, the increase is already included in your starting amount. This is especially important for people delaying retirement. The COLA does not disappear just because you haven't claimed yet. It quietly builds into your benefit over time. That said, COLA does not exist in a vacuum. While your gross benefit goes up by 2.8%, other costs may rise at the same time. Medical expenses, insurance premiums, and everyday living costs can reduce how much of that increase you actually feel. The takeaway for 2026 is this: COLA provides meaningful protection against inflation, but it does not guarantee a higher standard of living. Understanding the timing and the real-world impact helps set realistic expectations. Medicare Part B. In 2026, why your COLA increase may feel smaller. In Part 11, we talked about the 2.8% COLA increase coming in January 2026. Now it's time to talk about the factor that often reduces the real impact of that increase for millions of seniors: Medicare Part B premiums. For 2026, the Medicare Part B premium is increasing again, and for most beneficiaries, this premium is automatically deducted from their Social Security check before the money ever reaches their bank account. That means even though your gross Social Security benefit goes up due to COLA, the net amount you actually receive may increase by much less, and in some cases, it may barely change at all. This is where many seniors feel frustrated. On paper, Social Security announces a COLA increase, but in reality, rising Medicare premiums can consume a significant portion of that adjustment, especially for people with modest benefits. For most retirees, Part B covers doctor visits, outpatient care, preventive services, certain medical equipment. Because Part B is essential coverage, most seniors stay enrolled. Opting out is rarely practical, which means the premium increase is unavoidable for most people. Another important point: higher income beneficiaries may pay even more due to income-related monthly adjustment amounts, often called IRMAA. These extra charges are based on tax returns from prior years, and they can further reduce your Social Security deposit. The key takeaway for 2026 is this: When budgeting for the year ahead, don't look only at your COLA percentage. Look at your net benefit after Medicare deductions. That number is what truly determines how much you can spend each month. Practical steps for 2026: how to protect your benefits and avoid surprises. At this point in the series, we've covered a lot of numbers, limits, and rule changes. Now it's time to focus on what actually matters most: the practical steps you can take in 2026 to protect your Social Security, SSDI, and SSI benefits. The first and most important step is to write down the numbers that apply to you. These limits are not suggestions, they are hard rules. If you are on early retirement and still working, you need to remember $24,280. If you are on SSDI, you need to know whether your limit is $1,690 or $2,300 depending on your classification. If you are on SSI, you must keep the asset limits front and center. The second step is to track your income consistently throughout the year. Do not wait until December to realize you crossed a limit in March or June. Income tracking should be monthly, especially for SSDI recipients, because even one high-earning month can trigger serious problems. The third step is to explore additional assistance programs if you qualify. Many people receiving Social Security or SSI are also eligible for programs like SNAP food benefits, Medicaid, prescription drug assistance, or state utility relief. These programs can stretch your income further without risking your primary benefits. The fourth step is to contact Social Security directly when you are unsure. Yes, hold times can be long and the process can be frustrating, but getting clarity early is far better than dealing with overpayment notices, appeals, and months of uncertainty later. Finally, remember that these rules are not designed to punish you. They exist to keep the system functioning, but that doesn't mean they're always easy or fair. The people who do best under these rules are not the smartest or the luckiest. They're the ones who stay informed and proactive. Final thoughts for 2026. Stay informed. Stay protected. As we wrap up this series, it's important to step back and look at the bigger picture. The changes coming to Social Security, SSDI, SSI, and Medicare in 2026 are not just technical adjustments. They directly affect how much money you have to live on each month and how secure you feel about the future. For many seniors, even a small mistake can have serious consequences. Earning slightly too much, saving a little more than allowed, or misunderstanding when a rule applies can lead to reduced benefits, overpayment notices, or months of stress trying to fix an issue after the fact. That's why preparation matters. If you are turning 65 in early 2026, this year is especially important for you. Enrolling in Medicare on time is critical to avoid late penalties and gaps in coverage. Medicare decisions can be confusing, but getting them right protects both your health and your finances. The most powerful tool you have is information. You don't need to master every regulation, but you do need to understand the rules that apply to your situation. Write the key numbers down, review them occasionally, and don't hesitate to ask questions before a problem starts. Social Security was designed to provide stability and dignity in retirement and disability. While the system has its flaws, millions of Americans successfully navigate it every year. You can too, with the right knowledge and a little planning. Thank you for taking the time to follow this series. If you found this information helpful, consider sharing it with someone who might need it, a spouse, a neighbor, or a friend. Staying informed doesn't just help you, it helps your entire community.